Hi everybody, and welcome to our first video in Chapter 1, where we will be going through managerial accounting and cost concepts in a little more depth than we did in the prologue videos. And here, we're going to take a look at what financial accounting is, and of course it's concerned with reporting financial information to external parties, such as stockholders, creditors, and regulators. Managerial accounting is concerned with providing information to employees within an organization so that we can formulate our plans, control our operations, and generally make better business decisions. So in a way, managerial accounting is not quite accounting. It is really almost, in many ways, good common sense. And here we're going to look at the purposes of our cost classifications. Number one, assigning costs to cost objects. Number two, accounting for costs in manufacturing companies. Number three, preparing financial statements. Number four, predicting cost behavior in response to changes in activity. And finally, number five, making decisions. Okay, so our first learning objective is understanding these cost classifications that we use for assigning costs to cost objects. We have direct costs and we have indirect costs. What are direct costs? Well, direct costs are costs that can be easily and conveniently traced to a unit of product or other cost objects. Some examples include direct material and direct labor, whereas indirect costs cannot easily or conveniently trace to a unit of product or other cost object. And one example would be manufacturing overhead. So, what are these common costs? Indirect costs incurred to support a number of cost objects. These costs cannot be traced to any individual cost object. So let's look at this in a little more depth. We're going to identify here and give examples of each of the three basic manufacturing cost categories. And here they are. 1, direct materials. 2, direct labors. And 3, manufacturing overhead. Those are our basic product costs in a manufacturing company. So direct materials are raw materials that become an integral part of the product and that can be conveniently traced directly to it. So if we put a seat into an aircraft, that seat is direct materials. Now, direct labor are costs that these labor costs can be easily traced to the individual units of the product. Wages paid to automobile assembly line workers would be a fairly easy example that would illustrate that. Manufacturing overhead includes all manufacturing costs except direct material and direct labor. These costs cannot be readily traced to finished products. So we have indirect materials that cannot be easily or conveniently traced to specific units. We also have indirect labor that cannot be easily or conveniently traced to specific units of product. And then we would have other manufacturing overhead as well, such as rent and electricity, utilities, that kind of thing. So manufacturing overhead would include depreciation on manufacturing equipment, utility costs, property costs, insurance premiums incurred to operate a manufacturing facility, and then only those indirect costs associated with operating the factory, not the corporate office, but the factory, are included in manufacturing overhead. So these are key definitions here. We have prime costs and conversion costs. So we classify that as follows. If we have direct material and direct labor, those are our prime costs. But then when we convert those direct materials into a product, the conversion cost includes direct labor and manufacturing overhead. You'll see why conversion costs particularly will be more important as we proceed in the subsequent chapters. So here, non-manufacturing costs, those include selling costs, costs necessary to secure an order, deliver the product. They can be either direct or indirect costs, and general and administrative costs, as it's often called, G&A, all executive, organizational, clerical, those kinds of costs. Administrative costs as well can be either direct or indirect costs. So as we understand cost classifications used to prepare the financial statements, we're going to take a look at product costs and period costs. Key definitions there: product costs and period costs. Product costs are those costs that include all the costs involved in acquiring and or making a product. Product costs attach to a unit of product as it is purchased or manufactured, and they remain attached to each unit of product as long as it remains in inventory awaiting sale. Manufacturing product costs in a manufacturing environment, the manufacturing product costs flow through three inventory accounts on the balance sheet. Number one, raw materials. Those include any materials that go into the final product. Number two, work in process inventory. That consists of units of product that are only partially complete and will require further work before they're ready to sale to the customer. Finished goods consist of completed units of product that have not yet been sold to customers. All right, transfer of product costs. When direct materials are used in production, their costs are transferred from raw materials inventory to work in process inventory. And then the direct labor and manufacturing overhead costs are added to work in process to convert direct materials into finished goods. Again, you'll notice that direct material and manufacturing overhead are conversion costs. And number three here, once units of product are completed, their costs are transferred from work in process to finished goods. And when a manufacturer eventually sells its finished goods to customers, those costs are transferred from finished goods to cost of goods sold. So, product costs. Those are going to include direct materials, direct labor, and manufacturing overhead. Product costs. Period costs will include all the selling and G&A administrative costs. Now, you will notice that this diagram indicates that inventory is reduced when we actually sell it to the customer, and we increase our cost of goods sold on the income statement when we actually sell that product. There's a delay there oftentimes in reporting that cost of goods sold because it's not reported until it's sold. Whereas period costs are expensed in the period in which they are incurred. Okay, selling expenses and G&A expenses. Okay, so if we take a look at a quick check here, which of the following costs would be considered a period rather than a product cost in a manufacturing company? Alpha, manufacturing equipment depreciation. Bravo, property taxes on corporate headquarters. Charlie, direct material costs. Delta, electrical costs to light the production facility. And Echo, sales commissions. And I think that one's going to be pretty easy. It's going to be Echo, sales commissions. Depreciation is going to be in manufacturing overhead. Direct material is going to be in directly associated with the product is direct material. Electrical cost to light the production facility, again, will be in the overhead pool. Okay, now let's take a look at understanding cost classifications used to predict cost behavior. We have variable costs, fixed costs, and mixed costs. Very important definitions. Okay, cost behavior refers to how a cost will react to changes in the level of activity. The most common classifications are variable costs, fixed costs, and mixed costs. So let's take a look at those. Variable costs is a cost that varies in total in direct proportion to the changes in the level of the activity. The variable cost per unit is constant. However, the more we make, the higher our variable costs in total will be. So here is our units produced. It's a measure of what causes the incurrence of a variable cost. Machine hours, labor hours, units sold, units produced, those kinds of things we can say are cost drivers. A fixed cost is going to remain constant in total, regardless of the change in the level of activity. So things like rent on the building, no matter if we make 1 or 1 million units that month, the rent remains the same. So expressed on a per unit basis, however, the average fixed cost will vary inversely with changes in activity. The more the activity, the less the fixed cost per unit. In total, fixed costs remain constant, in theory. Okay, types of fixed costs. Committed. These are multi-year planning horizons that cannot easily be adjusted in the short term. Rent is a perfect example of that. Discretionary. Those arrive from annual decisions and easily reduced in the short term. Okay, linearity assumption and the relevant range. So here's our relevant range here. And as you can see, as it's depicted in this graph, that activity total cost is assumed to be linear. Whereas an economist's curvilinear cost function, shown here, that essentially says that once you get past that relevant range, your costs are probably going to go up. In other words, if you're selling all of one shift, that shift will be fine within the relevant range. And once you try to push units past that capacity, I've got to spend a lot of money in overtime and extra maintenance costs and those kinds of things, which will drive your costs in total up from a linear condition. So the accountant's straight line approximation, that's the constant unit variable cost. And it closely resembles a curvilinear variable line within that relevant range. Okay, that looks like a good place for us to stop this video. And when we return, we'll take a look at fixed costs and how that is impacted by the relevant range. Until that time, bye for now.